You look for simple buy and sell indicators, you follow every signal, and you still lose money. That is where most traders are stuck. And the reason is not what most people think. It's not because the indicator is bad, and it's not because the signals are random. The real reason is much quieter than that. Most traders are trading without knowing what kind of market they are in, uptrend, downtrend, or something far more dangerous. And this is one specific condition when traders lose money even when their signals look perfect. I will show you the conditions later because even traders who understand the trend still lose there. First, let's make the mistake visible. Look at this gold 1 hour chart. On the chart, there's an indicator applied directly to price and it has a midline running through the candles and one dotted line above it and one dotted line below it. That dotted lines form a band that price moves inside it. The indicator also generates signals when price crosses the midline, and a cross above produces a buy signal and a cross below produces a sell signal. Now look at this section of the chart. Price crosses above the midline and a buy signal appears. You take a long trade and price reaches the target. Clean, simple, profitable. Then look at another section of the same gold chart. Price crosses below the midline and a sell signal appears. You take a short trade and that trade also hits the target. In moments like this, the indicator looks flawless. The signals appear reliable, and this is exactly why traders start trusting every signal it produces. Now pause for a second and look at the different section of the chart. Here, the exact same signal appears. You take a buy, it hits a stop loss. You take a sell, it hits a stop loss. Again and again. Nothing changed on the indicator. Nothing changed in the rules. The only thing that changes was the market condition. And this is where most traders quietly destroy their accounts. This is usually the moment when traders blame the indicator and add more tools or jump to a new strategy. And that reaction is the real mistake. The problem is not the signals. The problem is taking signals without permission from the market. Now look at below the chart. You will see an oscillator. This oscillator has 3 parts: a histogram, a filled area, and a horizontal midline. This tool is not for entries. This is not for exits. Its only job is to answer one question before every trade. What is the market doing right now? When the histogram is green and above the midline, the market is on an uptrend. And here's where most traders already mess up. Direction alone is not enough. Weak trends destroy accounts just as fast as no trend at all. That is where the area matters. When the filled area is also above the midline, it confirms that uptrend has momentum behind it. When both histogram and area are above the midline, the market is bullish with a strength. In that condition, buy signals are allowed. Everything else is noise. Now here's the consequence. If you ignore this and take sell signals during this condition, you're trading directly against momentum. This is why those traders get stopped out repeatedly. Now look at this opposite situation. When the histogram is below the midline and turns red, the market is in a downtrend. Again, direction alone is not enough. If the filled area is also below the midline, bearish momentum is confirmed. When both histogram and area are below the midline, the market is bearish with a strength. In this condition, the rules flips completely. You only look for sell signals. Every buy signal must be ignored. Traders who ignore this end up buying pullbacks that never reverses. Now look back at the gold 1 hour chart. When the histogram and area are both above the midline, every sell signal is ignored. Those sell signals are counter trend trades. Counter trend trades are not unlucky trades. They are structurally weak trades. Ignoring them removes a large percentage of losses automatically. You can see a sell signal appears while both conditions are bullish. That signal is ignored. No hesitation, no debate. Then a buy signal appears while the histogram and area are still above the midline. That signal is allowed. Now pause here, because this is where discipline starts. Even allowed traders are not taken without risk management. You never risk more than 1% per trade. This is not optional. Traders who break this rule do not blow up because of bad strategies. They blow up because drawdowns compound faster than recovery. Every trade must also have a stop loss, and this buy trade, the stop loss is placed slightly below the lower dots of the indicator. If price reaches that level, the trade idea is invalid. The target is set 1.5 times the risk. That creates a positive risk to reward ratio, which is what allows the strategy to remain profitable over time. As price continues to move, the rules do not change. As long as the trend remains bullish with momentum, sell signals are ignored and buy signals are taken. No adjustment, no anticipation, no emotions. Now here's the rule most traders never apply correctly. This is the condition I warned you about at the beginning. When the histogram and area are not at the same side of the midline, the market is ranging. It does not matter what color the histogram is. If one is above the midline and the other is below it, there is no clear trend and no real momentum. This is where traders who understand trend still lose money. In this condition, you do nothing. You do not buy, you do not sell, you stay out completely. Traders who ignore this rule trade inside noise, and noise is where indicators fail the most. This single rule avoids losses before they even appear on the chart. If you stop watching before the rule, you still lose in ranging markets. This is why this matters. Now, the structure should be locked in, but there's one final trap. The indicators are free. The default settings are the trap. Out of the box, the indicators produces too many signals and too much noise. This strategy only works when the tools are tuned correctly. The signal generator used here is the half-trend indicator. The default settings do not work. So, in the Inputs tab, set the amplitude to 7. Then, set the channel deviation to 4. The trend identifier used here is the Impulse MACD by Lazy Bear. Now, we also need to change the settings of the Impulse MACD indicator. The length MA should be set to 200, and then the length signal should be set to 100. In the style settings, the midline is set to white, the Impulse MACD should be changed to columns, and then the Impulse MACD signal and the bar colors option should be disabled. Now the chart is clean. Direction decides permission, momentum decides confidence, signals produce timing, risk decides survival. Apply this exactly as shown. Happy trading!